Well, welcome everybody. Tonight, we're going to be talking about accounting for accounts receivable, particularly bad debts. It's one thing to invoice your customers. It's another thing to collect from the customers. So how do accountants account for these potential bad debts? Because inevitably, unfortunately, no matter how well you do your credit checks and references, all that good stuff, you have some customers who just don't happen to pay you. It just happens. I wish it didn't, but it does. So we're going to see how businesses account for that, how accountants account for bad debts. There are two basic methods to account for bad debts. There's a direct write-off method. And a direct write-off method, that is not GAAP. Okay, GAAP says that you must use an allowance method. So there's two methods here. The direct write-off method, it's not GAAP. It's used for small write-offs. You have couple $100 or $1,000 here or there to write off, but it's not used for your main write-offs. You want to use the allowance method. And what is the allowance method? The allowance method says you estimate what your bad debts are, and you set that money aside, like an allowance. And as you have bad debts, you satisfy those bad debts by taking money out of the allowance account and writing off the receivable. So the direct write-off method would just expense the bad debts as they happen, but GAAP says, general accepted accounting principles, GAAP says, no, you must account for these bad debts, estimate them. So you want to estimate the expense with the revenue. And that's part of the matching principle of accounting. You want to match the expense with the revenue. So we estimate what the bad debts are. And then we set this money aside in this contra asset account called allowance for doubtful accounts. We're going to see in a demonstration in a few minutes. So what's a contra asset account? Has a contrary or opposite balance. Assets have a left side or a debit balance. Well, the allowance for doubtful accounts would have an opposite balance, has a credit balance, or a right side balance in the T account. Okay, so that's a contra asset account. And the debit receivables and the credit balance in allowance for doubtful accounts, they net against each other. You get your net receivables, your net accounts receivable. Debits and credits net against each other. So you have a debit balance of whatever, say $1 million in receivables, and let's say you had $10,000 in your allowance for doubtful accounts. You would net those two together, you'd have $990,000 of net receivables on your books. Okay, so that's what we have here. We have the direct write-off method, which again is not GAAP, but allowance method is. That is the acceptable method to account for bad debts. And under the allowance method, there are two main approaches. One is the income statement method, which is the percentage of sales approach, which says, historically, let's say we had 1% of all our sales, we never end up collecting. So if that was the case, we would make an entry and build up the allowance account by taking 1% of our sales, multiplying our sales by 1%, and use that number to put into the allowance account at the end of the year by debiting bad debt expense, crediting the allowance for doubtful accounts. But so that's the income statement approach. Then you have the balance sheet method. The balance sheet method is an aging of receivables approach, which I happen to like this one. It's a little more intuitive. You're looking at actual aging of your receivables. So obviously, the older your invoice gets, the less likely that you will collect that money. Okay? It's very important to stay on top of your receivables and collect your receivables in a timely manner. So you want to stay on top of your customers. Okay, so we're going to be looking at the allowance method in a bit, and we'll be focusing on the balance sheet method in this case, in this demonstration. And I have a spreadsheet we'll go over with together in a couple of minutes. Okay, so the balance sheet method, the aging of receivables. Again, as I mentioned to you, as an invoice gets older, the less likelihood you're going to collect that money. So again, you're going to get on the phone or send out the emails, whatever, call your customers, make sure you're on top of them. Unfortunately, you heard the expression, a squeaky wheel gets the grease. Well, sometimes you have to be a little squeaky with your customers. You have some customers who are great. They pay right on time, no problem. You don't have to call them at all. We get some other customers, they'll just, if they don't hear from you, they'll just put the payment off. And you know, suppose you give them a call, say 35 days, if you have terms of 30 days, and 30 days have come and gone, now you're day 35, give them a call. It was the money. And then, oh, it's in this week's check. Okay, great, thank you. If you didn't call them, it'd be maybe in the next week's check. So again, stay on top of them, make sure you collect those receivables in a timely manner. Again, the longer the age, the less chance you're going to collect on them. All right, so let's look at the aging of receivables. I have a problem here that we're going to go over. Let me click on that and let's go right at it here. So here's the aging of a receivables method. We have this company called Killebrew Inc. uses the aging of receivables method to account for the allowance for doubtful accounts and the recording of bad debt expense. Below is the aging of accounts receivable along with the associated estimation of uncollectability. Okay, so A, we're going to calculate the amount estimated to be uncollectible at the end of the year, 2021 in this case. B, record the year-end entry to record the bad debt expense if there was already a credit balance in the allowance for doubtful accounts at the end of 2021 before this adjusting entry. Okay, so in this scenario, we're going to make an entry, an adjusting entry at the end of the year to put more money into this allowance account. Okay, it's almost like setting up a budget. Okay? We're setting up based upon the aging of our receivables. We're going to make an entry to put more money into this account so that we have money set aside to satisfy any of these invoices that may not get paid. Okay, and then C, we're going to write off a balance January 15th of the customer in the 120-day column. We're going to find out in January 15th that this customer is not going to pay us, so we're going to write it off. So that's what we're going to do. So the first we need to do is calculate the estimated to be uncollectible at the end of 2021. So let's look at this table. Killebrew Inc. has a total of $2.2 million roughly in accounts receivable, okay, of which $1,687,000 is in the 1 to 30 days range in terms of how old they are. So some of this is fresh new invoices for the most part within the current month. Then you have a 31 to 60 day bucket. These invoices are 31 days to 60 days old, not past due, just old. Okay. And then you have $105,000 in the 61 to 90 day age bucket. Then the 91 to 120 of $82,000, and over 120 days, you have $48,000. Okay. So then look below here, we have estimated uncollectible percentages. So what this company is saying, based upon history, based upon what they believe and from their customers and how the customers behave and their paying patterns and all that good stuff, that anything that's a current invoice is a 1.5% chance we'll never see the money again. Okay. And then in the 31 to 60 day, when an invoice gets into the 31 to 60 day range, there's a 4% chance we'll never see that money. And when it gets to be 61 to 90 days, there's a 6% chance we'll never see the money. When it gets to the 91 to 120, a 20% chance. And as you see, if it's greater than 120 days, there's a 65% chance we'll never see that money. Okay, we could, but again, these are estimated uncollectible percentages. It's not cast in stone. Hopefully we'll collect this money, but you're going to see when we get to part C, we didn't collect it. Okay, so let's estimate the amount uncollectible at the end of 2021. We built this little table here. Right, so we're going to look at that table. So the first column, we're going to have the age in days. Then the next column over, we'll have the accounts receivable balance. And then the next column over, we'll have the estimated collectible percentage. And then we'll see the next column will be the estimated uncollectible amount. Okay. So the first bucket, we have the 1 to 30 days. Let's find that 1 to 30 days. We see there's accounts receivable balance of $1,687,000. And the estimated uncollectible percentage is 1.5%. So the estimated uncollectible would be the $1,687,000 times the 1.5%, or $25,305. So of this $1,687,000, we need to set aside $25,305 in the allowance account. But we're not done because that's just one bucket. Let's take a look at the others. Now we have 31 to 60 days right here. And the accounts receivable balance for that bucket of invoices is $330, and the estimated uncollectible percentage is 4%. And then the calculation is $13,200 as the amount uncollectible estimated for that bucket of invoices. Then we have the 61 to 90 days, find that. And that balance is 105,000. The estimated uncollectible percentage is 6%. And we multiply those two cells together, you get $6,300 as the potential uncollectible for the $105,000. And then we have the 91 to 120 days. And the balance is 82,000. The uncollectible expense is 20% in this case. So 82,000 times 20% is $16,400 of uncollectible potentially, okay, estimated. And then we have the last bucket, over 120 days. We grab that balance, $48,000, and it's estimated to be uncollectible at 65%. So 48,000 times 65% is $31,200. Then we just total these up. Okay, so we have 2,252,000, which ties to our balance sheet, that ties to our aging. Okay, and then we have an estimated uncollectible of 92,405. Okay, so all that math shows that we have 92,405 of estimated uncollectible receivables. So we need to make an entry at the end of the year to make this allowance for doubtful accounts equal the 92,405. Well, how do we do that? Well, we already have $5,000 in the account, right? So we're going to make an entry for the difference, 92,405 minus what's already in the account. We'll make an entry for 87,405 to make sure that we have 92,405 in the allowance of doubtful accounts. So when January 1st comes around, right, we're gonna make this at the end of the year, December 31st, 2021, we're gonna make a journal entry for 87,405. So what does the entry look like? Well, we're gonna make this entry. It says record the entry, year-end entry. If there was a credit balance of 5,000 in the account, as we already saw up here, it's 5,000. So we'll make an entry for 87 because the 5 plus 87 equals the 92. So we're gonna debit bad debt expense. Find the account here. There it is. Bad debt expense for 87,405. And we're going to credit the allowance account, the contra asset account called allowance for doubtful accounts for the 87,405. So we're going to put that money, but when we post this to our ledger, we're going to have a balance sitting in our ledger of 92,405, which ties out to our schedule that we calculated here, the amount we calculated on our schedule. All right. So that's how you account for bad debts. And as you have write-offs, what happens? So on January 15th, we get the news that this customer here is not going to pay us. All right, it's too bad, it happens. Well, good news is we have money set aside. The bad news is we have to write it off. The good news is we have some money set aside. So we're going to debit the allowance account to pull money out of the allowance, the $48,000. And we're going to write the invoice off. So accounts receivable comes off the books. And there you have a write-off of the receivable. Okay, so you put the money in the allowance account, you use the allowance account to write off. So again, the allowance account is a credit balance, it's a contra asset account. When it increases, you put the increases on the right side. This account is increasing. Okay, and when it decreases, when allowance of doubtful accounts goes down, we're going to debit it. It goes on the opposite side. Okay, that's how you account for bad debts. All right, well, using the allowance account. All righty. The next thing we want to talk about is accounting for notes receivable. Notes receivable. Sometimes customers will do business with a note. Instead of send them an invoice, they'll make a promise to pay you the amount of the invoice plus interest, typically, at a certain period of time. But sometimes if customers have a hard time paying, and you have an invoice, you've been calling them and say, hey, listen, I'll pay you 60 days from now, and I'll give you 5% interest. And I promise to pay out and make a promissory note, and they'll pay the principal and interest to you in 60 days. That's another way a note can come on the books. And so let's take a look at that. I have some key terms here. Let's go over that before we get into the exercise. So let's call up that screen here and take a look at it. So here we have the accounting for notes receivable. It's a promissory note. Why? Because the maker of the note is making a promise to pay a certain sum of money owed plus interest in most cases. Okay, so then it's a promissory note. The maker of the note is promising to pay a certain sum of money at a certain period of time plus interest. Okay, so let's take a look at an example here. Let's say, so key terms. The date of the note is when the promise is made. Okay, let's say the date of the note, let's say the promise was made December 15th. Oops, sorry about that. December 15th, they made a promise to pay. Okay, now let's say they bought that they owed us $5,000, so they promised to pay us $5,000. Okay, and they're going to pay us interest of 5%. Okay, 5% interest. The term of the note is going to be 60 days. Okay. What's the due date of the note? Okay. How do we calculate the due date of the note, and how do we calculate the interest due, and how do we calculate the maturity value? So we need to calculate these things. We need to calculate the due date, the interest due, and the maturity value. How do we calculate that? Well, the interest is a universal formula here, principal times rate times time. So if we calculate that, we can calculate the interest by looking at, put a formula in here, the principal, which is $5,000, right, times the interest rate, which is 5%, which is an annual interest rate. You never see an interest rate that's expressed as an annual interest rate. So what we need to do is multiply it by the time factor. Okay? And the time is 60 days divided by 360. There's 365 days in the year, but for interest calculations, we use 360 to keep it simple. So the amount of interest due on this note is $41.67. $41.67. Okay. So the maturity value of the note would be the amount due at the date of the due date, the maturity value at the maturity date or the due date. So how much will the maker of the note, the promise, the person making the promise to pay? Well, it's going to be the principal of $5,000 plus the interest of $41.67. They're going to pay $5,041.67. Okay. So now we need to calculate what the due date is. So the due date of the note, there's a couple ways to do it. Let's do it the old-fashioned way first. So the note was made on December 15th. How many more days are left in December? Okay. If the note was made on December 15th, there are 16 days left in December, right? 31 days in December. The next month is January. January has how many days? 31. So far we've accounted for 47 days out of the 60 days. So now we come to the next month, February. February has 28 days, but we don't need all those days because we've accounted for 47. How many more days we have to go? 13 more, because if you add up these days, they come out to 60 days. All right? So the due date of this note is going to be February 13th. Okay? February 13th is the due date of this note. All right? So that is the old-fashioned way to do it. But now we have Excel. It's a lot easier. And I'll show you a little trick right here. Calculate. Let's put in the date of the note. Let's say it's December 5th, 2020, and it's 60 days. what's the due date of the note? We can take the December 5th, oh, sorry, 15th date, sorry. Let me change that, 15th, hello. We can take the December 15th date, add the 60 days to it, and we get February 13th. Look at that, February 13th. How does Excel know that this date plus 60 equals February 13th? Well, I'll tell you a little secret about Excel if you don't know already. If I convert this, if I format this cell into a number, you're going to see that behind every date, there is a number. That's how it does the calculation. So December 15th is day number 44,910. February 13th is day number 44,970. So that's how Excel knows and does the math for you. Okay, so there you have it. So now we're getting into an exercise we'll do together. Well, you'll watch me do it. All right, and now let me stop sharing. Don't let me go to the other spreadsheet. Excuse me. Here we go, right here. Accounting for notes receivable. Because October 12th, Carew Corporation accepted a 120-day, 3% note from a customer in exchange for their past due receivables. So they came to Carew and said, I can't pay you right now, but I can pay you 120 days from now. I owe you 100,000. I'll give you 3% interest. Just bear with me. I'm making this promise of a more formal instrument now, a promissory note instead of an invoice. So the old receivable comes off the books and a new receivable goes on the books. And we're going to see that when we look at the entry. So October 12th, what happens? We're going to put the notes receivable on the books. Notes receivable goes on the books for $100,000. And what's coming off the books? The accounts receivable is coming off the books. So the invoice is coming off the books and is replaced by a more formal instrument called a note receivable. The maker is making a promise to pay us $100,000 plus interest. So what is the due date of this note? October 12th, right? What's the due date of a 120-day note? Well, we can do it here. Let's put it here. October 10, 12, 22, and it's 120 days. So October 12th plus 120 days. The due date of the note is February 9th. Okay. How much interest is due on this note? Well, interest is principal times rate times time. So we know the principal is $100,000. We know the interest rate is 3% or 0.03 is 3%. Right, so 100,000 times 0.03 times 120 days divided by 360 days in the year. Okay, we're only going to be they're only borrowing this money for 120 days, not 360. So the interest is going to be $1,000 for that 120-day period. Okay, it's $3,000 for a whole year, but it's only $1,000 for a 120-day period. So what's the maturity value of this note? It's the principal of 100,000 plus the interest, right? So it's $100,000 plus $1,000. So $101,000 is the amount that is due on February 9th, the due date of the note. Okay. So now we need to, well, we did D already, journalize the acceptance of the note on October 12th. There's the entry to put the note on the books and take the old invoice off the books. And then now we're going to journalize the entry to accrue interest earned as of December 31st. So because they have on a fiscal year that their fiscal year ends in December. Not all companies end in December, but this company does, the fiscal year. So we're going to need to accrue the amount of interest earned for the amount of time that we are holding the note. Okay, so how many days is that? Well, it's going to be, we can do it a couple of different ways. We can put 12/31/22 here and then do the math. 12/31/22 minus October and convert this to a number. Is format the cell, change it to a number. And we have 80 days, okay? So 80 days from October 12th through December 31st. So of the 120 days, 80 days will be earned in fiscal year ending December 31st, 2021. So we need to make an entry to put the interest receivable on the books. We're not going to get the interest until February 9th, right? And that's going to be $80. No, I'm sorry, not $80, 80 days. So what's the interest going to be? It's going to be the $100,000 principal times rate times time, right? 100,000 times 0.03 times 80 divided by 360, right? 80 days divided by 360. So in this case, we have $667 being accrued for the amount of interest that we've earned for the 80 days from October 12th through December 31st. And we're going to put on interest revenue, interest earned, whatever you want to call it, interest revenue of $667. Okay, so that's on the books as of the end of the year. We want to make sure we match the revenue in the proper period, or we recognize revenue when it's earned. We have earned this revenue. We haven't received the money yet. We're going to get the money on February 9th, but we're going to record the interest that's earned. So now on the February 9th, we're going to make an entry to record the note that's going to be received on February 9th. Okay, February 9th, which is the due date of the note when we calculated earlier. Remember? So we put 120 just to go back to that. Okay, February 9th. So what's happened? We're getting cash. How much cash are we getting from the maker of the note? How much money is Carew getting? They're going to get the maturity value, the $101,000. Hopefully, they're going to get $101,000 that is due. What happens? The note receivable comes off the books. Okay, because it's paid off. Okay, again, notes receivable and on the books as a debit, comes off the books as a credit. Okay, now the interest receivable comes off the book, because now we have the money. Okay, so the interest receivable of 667 comes off the books. And we record the remaining interest revenue. Of the $1,000, we've already recorded 667. So the remaining 333 will be earned in the fiscal period 2022. Oops, come on, come back. Okay. Interest revenue. Okay, so that's how to account for notes receivable. Okay. Again, if you want to do this, just to do the math to make sure it equals 333, it's the principal times the rate times the 40 days now from January 1st to February 9th, and that's, whoops, what happened? Divided by 360, $333. Okay, so that's how you account for notes receivable. I hope you've enjoyed that. I hope you learned something. Stay tuned for another episode of Accounting is Fun. I'll see you all next time.